It was another exciting day on Wall Street here. Of course, election day for the midterms here in the United States as well. We'll find out more about the results for tomorrow's trading, but for today, we did have some volatility throughout the session. Early in the day, we were up over 1%, and then we gave up all of those gains, actually went into the red for a while before recovering and closing up by about 0.5% when it was all said and done. But once again, it was the Dow that was leading the way within this market and not some of the more high octane areas like the tech stocks. In fact, today we saw materials from a sector perspective doing pretty well, and unfortunately discretionary lagging due to some underperformance out of Tesla and Amazon. So we'll go through all of that information. We'll also have a little bit of a conversation on cryptocurrencies tonight, which is a bit rare for me, but there was a lot of hoopla about that in today's trading, so we'll review some of that. We'll take a look at our postures across the various sectors with our sector selector tool, and then we'll get into our trade application example where I wanted to focus on a very well-known hotel chain that has kind of fallen into a sideways channel that might be setting up nicely for a neutral strategy like an iron condor. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 8th, 2022, Election Day. Hope you all are having a great day so far. Reminder that we do have a YouTube channel, of course, and we invite you to subscribe to that channel. In the description area below our daily videos, you'll also find a link that will get you signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also be given a heads up at the bottom of those emails which stocks are giving you overbought and oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts, and also the other content that David and I put together. Some of you might have seen that I just put together a 17 tweet thread on my experience as an investor in Archer Daniels Midland here over the past decade. So if you enjoy learning from more of that firsthand experience as opposed to out of a textbook, be sure to support those types of tweets with your likes and retweets there as well. And then last but not least, we do have a presence on Facebook. If you're not already part of our group, feel free to join it with that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got my S&P 500 heat map pulled up here in front of us. And it was largely a bullish day in the market, but there was a bit of volatility throughout the session. We were up well over 1% in the morning, and then eventually all of that 1% went away, and we actually were trading in the red for a while, and then we had a late day bump towards the close where we did close higher by about 0.5% when it was all said and done. So a little bit more chop here today as we kind of sorted through any sort of election news that might be filtering its way into the economic system. Of course, it's still pretty early here on Tuesday night, so we're not going to have a lot of the true results. Nonetheless, sometimes the market can try to predict things here or there, and that might have some influence. But largely it was a bullish day for the markets. As you can see, a lot more green than red. And some of those green areas really lit up quite brightly. There's good old Amgen down below. For those of you that have been in my dividend growth investing classes over the years, you'll know that we've purchased that stock a lot of times over the last 8-9 years or however long I've been teaching you. So a lot of us are very, very, very happy to see Amgen hitting all-time highs here today, up about 5.5%. I'm less enthusiastic about Medtronic, which is right next to it, another great dividend growth stock. It was heading in the opposite direction here today, down about 6%, but they were kind of an outlier. I think they had company-specific news. For the most part, most healthcare stocks did finish the day higher. You'll notice that a lot of tech stocks also finished the day higher, with some of those brighter green squares and rectangles showing up here. In the case of SolarEdge, up 19% today. That's a solar energy focused semiconductor company. And then one of their direct competitors, Enphase Energy, also went up in sympathy, up about 4% in that particular case. PayPal had a nice day, up over 4%. Fortinet was up over 5%. in some of that internet security area. Of course, we've had some trades in those areas here more recently with Zscaler and CrowdStrike to the bearish side, but here you saw Fortinet actually doing something bullish today, so go figure. Didn't even know that that industry had it in it after the ugly trading activity that industry has been subject to over the last 3 or 4 sessions. You'll notice that the big behemoths out there did close in the green as well. Microsoft was up 0.44%. Apple was up 0.42%. So not huge days out of those, but at least they weren't weighing us down like they were in a couple of occasions last week. Off on the right-hand side here, you will notice that discretionary had a tough session. Tesla was down 3%. Some of you that were in my factor-based swing trading class last Wednesday morning, if you're a premium member of Market Scholars, will know that we shorted Tesla last Wednesday. And of course, the stock has done terribly since then, which makes us quite happy with that particular trade, even though, of course, for the general market's purposes, we're not too enthusiastic about seeing any major leaders like this struggle the way that Tesla did today. But that was a pretty ugly day for them, easily down below 200 now, and makes you wonder, with Elon Musk spending so much time over at Twitter, if maybe the Tesla shareholders will suffer as a result, but we shall see. Another discretionary stock that struggled somewhat today was Amazon. It closed in the red. It was only down 0.61%, so I don't want to make it seem like it was a big deal, but hey, they are an influential member of the market due to their market cap, just under $1 trillion these days at $917 billion. Nonetheless, they were a bit of an outlier here today in the mega cap world and across the market in general, with most stocks closing obviously quite higher here today. Utilities were largely in the green here today after a tough day yesterday, and then energy was kind of a mixed bag here today, where you can see Exxon did go up and is still sitting close to all-time highs at $114 per share, but their chief competition there with Chevron was down just a touch here today, also close to all-time highs, but nonetheless they kind of landed on opposite ends of the ledger today, with Exxon up and Chevron down just a touch. All in all, it's been a pretty good run for many of those oil and gas companies, as we have been talking about pretty much all year long, and continues to be the case here at this moment. All right, let's go ahead and take a look now at, and by the way, I was going to mention as well, Disney closed down by 0.5% here today. But that's not the big news. The big news is what's happening after hours. And Disney after hours fell from 99.9, so $99.90 at the close, to at one point in the after-hours session was trading below $90 per share. It did recover some of that. Last I checked, it was at like $93, but they did report their earnings after hours here tonight, and Wall Street was not impressed, and therefore we could have continued selling pressure within some of that communications area tomorrow, all else being equal. Special shout out to Stacy out there as well. Been following some of your tweets out there. You did a great job calling that bearishness there on Disney. Keep up the good work. All right, let's go ahead and pop on over here now to the main part of the platform and get some breadth measures. And as you can see, I've got the S&P 500 pulled up in our index watch area of the market watch tab. And of the 500 stocks in the S&P 500, 350 of them closed in the green here today. And so that was good for a hit rate of about 70%. So again, your eyes were not deceiving you when you were looking at the heat map there a moment ago. Indeed, most stocks did close in the green today. So all in all, a pretty positive performance, strong market breadth for today. We'll see what tomorrow brings, but at least you can score this one for the bulls here today. All right, let's go ahead and pop on over to our main charts now. Keep in mind, I usually get started here with chart 4B, but I did want to point out that over the weekend, I posted an updated link to chart 4A. This is the one that David uses that you guys are probably familiar with his presentations, where you've got those bull and bear tags and things like that. So if you are a premium member, we did update our main document with the new shared think script if you wanted to import that into your own platform. So feel free to do that if that is of importance to you. And remember, that's one of the key perks that our 3-year premium members get with us is access to the 50+ charts that David and I use as well. And of course, we've got our Black Friday sale coming up here in a few weeks. So if you got friends or family that you think can benefit from a program with Market Scholars, then now is the best time to take advantage of that, or it will be here in just a few short weeks. So keep that in the back of your noggin there if you're considering joining our program. All right, let's get into our analysis now on chart 4B here so we can see all 4 of these major U.S. equity indices side by side by side. And, we usually get started here in the upper left with the S&P 500, as it is usually viewed as the most influential index out there, at least from an equity perspective in the United States. And S&P 500 was up 0.56% today, so it was an okay day. Again, it was kind of a goofy day where we started high, we got rid of all of our gains, and then we spent the rest of the afternoon trying to claw back some of those gains. So you'll notice here that you've got kind of like almost like a spinning top type of a candle that you're looking at right here. And oftentimes those can be viewed as indecision days, but a lot of times you won't know until the next day whether it proved to be the case or not. So we'll all be waiting to see how the markets open tomorrow after digesting more of the election results. But this was the 3rd day in a row to the upside for the S&P 500. So again, credit where credit is due. My mindset is still one of hesitation and caution, but I also want to stay flexible in my thinking if I am short-term oriented like we are in this particular presentation, right? This YouTube video usually caters to short-term traders as opposed to long-term investors. And so we have to, acknowledge that our gut will never be 100% perfect as to where we think the market should be going. And sometimes the market will do whatever it needs to do. And sometimes it does its best to frustrate as many of its participants as possible. So if right now there are too many people bearish in the market, it's possible the market will aggravate them by sending stock prices higher. So who knows? That's always a possibility. What I would say is that there are both positive and negative elements to the chart right now. On the positive side of the equation, as I just mentioned, we've been up for 3 days in a row, right? That's not necessarily something that we should just poo-poo. The market had a really tough time after Jerome Powell's interview on Wednesday of last week, but has stabilized quite nicely. And we're basically trading back to where that Jay Powell interview would have, been approximately when he started. So, it looked for a while like things could really spiral out of control to the downside, but that's not what occurred. And remember when I was with you on Thursday, that would have been this candle right here. I even hinted at that, even though my mindset was, again, more cautionary and things like that, but I did acknowledge verbally to you guys who listened to my video on Thursday that if the market was going to bounce, this would be a good day to use that excuse of bouncing up and off of its 30-day moving average. Because remember, we sliced through the moving average back here, kind of in the middle to end of October, and then we spent quite a bit of time above it, which is healthy, bullish type of behavior. We even had this really nice air pocket between where the stock was trading and where the moving average was, and then we get that rollover after the FOMC decision. But we didn't really ever breach that moving average. We sat right on top of it pretty much at its worst close, and we've now bounced 3 days in a row. So I don't want to throw that possibility underneath the bus. This is what you want to see, right? If you're bullish, you want to see a bounce. So I would definitely put that in the bullish camp. The other thing I would put in the bullish camp is that we have a green 30-day moving average right now, which is basically letting us know that price is above a rising moving average. That is generally a bullish feature to a technical setup. The other thing that I mentioned on Thursday when I was last with you is that not only are we sitting right on that moving average, but with some of these indices, not all of them are exactly the same. I think I might have been mentioning this a little bit more so when I was talking about the Russell, but it still kind of exists there on the S&P 500 as well, where the idea that you get this pullback and then you have this prior resistance act as future support. right? And so for the Russell, we had that big sell-off after the FOMC announcement. In this case, it didn't quite touch the 30-day moving average, but it was already rotating higher and rolling up. And where that candle pretty much ended on that Thursday, I was with you last week, was sitting right on top of this prior resistance area back here on October 5th. So if that concept of old resistance becoming new support was going to play out, we would find out fairly quickly. And, you know, we had some good behavior based upon that theory. Now, today the Russell is actually down, whereas the other indices were up, so we're not going to necessarily throw it a parade, but you still have that same type of behavior where that was the ultimate low in the shortest term, and we have had a reasonable bounce since then, with today now starting to call into question the viability of that bounce with it closing just a little bit lower. Notice that kind of candle looks somewhat similar to the one with the S&P 500, but the S&P 500 is still outlined in dark green, whereas this one is now outlined in red, signifying that we did close slightly lower than yesterday's close on the Russell 2000. Notice that for both the S&P 500 and the Russell 2000, we do have those pink background colors telling us that we have a weekly bearish posture on those two. So that would go into the bearish camp, right? You'll notice that the green lines fell out of the upper reversal zone. And while that's not tremendously bearish, it's at least just giving us a little bit of a hint that there could be bearishness on the horizon. So it's kind of like, you know, those are the clouds that come in before the storm. Sometimes the clouds lead to nothing and they get blown away and all things are fine and well after that. But other times the clouds do lead to a legitimate storm. So going to that light pink background color is kind of your heads up that, you know, there is that possibility that a dark green background color, I'm sorry, a dark pink background color could be next. And that's where we stand with the NASDAQ. Notice down below you have this dark shading of pink as opposed to the light shading on the S&P 500 and on the Russell 2000. And I think that makes sense. You look at those three charts and it should be very clear, and even if it's not to those of you watching for the first time, assuming you've been listening to David and I for the better part of the last several weeks, you should know by now that the NASDAQ is our laggard at this moment in time. Now that can obviously change, and it will eventually, but right now it should be pretty obvious to your eye that the NASDAQ is the worst performer of these four indices. It's the only one below its moving average. Not only that, but its moving average is still falling. Notice that we've got green moving averages on the other three indices. The NASDAQ is the only one that's red. It's not even yellow. So this is still decidedly in a downtrend, and that's not a great look for the markets. Remember, we kind of need those NASDAQ stocks to help support the market. The NASDAQ had been the leader for so many years that they had a tremendous influence on the S&P 500 because of the market cap of the big tech companies like Apple, Microsoft, Nvidia, those types of companies you find on the NASDAQ. They ballooned over the years to basically drive performance within the S&P 500. So right now we're kind of seeing that concept not really holding its own, where a lot of the mega cap tech area has been the area that has been struggling lately. And there you're seeing why the NASDAQ composite is having a hard time getting stuck or getting out of its ruts, so to speak. It's stuck in the mud right now, right? We've got a little bit more benefit out of these other indices because there the focus isn't more purely on tech. And I know that NASDAQ does have some stocks from the other sectors as well, but it is still tech that really drives the NASDAQ. So with tech out of favor right now, the NASDAQ is the clear laggard. It was up 0.49% today. So notice that the intermediate line is below 50. It's at 34 and falling, and that is tremendously worse than the intermediate lines of the three other charts that we're looking at here, which all remain in territory above the 50th percentile. And then last but not least, in the upper right now, let's talk about the Dow Jones Industrial Average. Stop me if you've heard this before. And I'm just joking, of course, because sometimes I feel like a broken record. But the Dow Jones yet again led this market here today. It was up over 1% today, and it's the only index that can make that claim. So it has been impressive to say the least. as I mentioned to you guys last week, it's not surprising to see the Dow Jones outperform on the days when the market is down. It is surprising to see the Dow Jones lead all of the other indices when the stock market is up. And so we've seen both of those iterations in the last month or so out of the Dow. More times than not, it has been the leader on the upside, like it was today. And then on those rare down days, more times than not, the other indices are down worse than the Dow. So this has been a really interesting time for the big blue chip dividend-oriented companies out there. I mentioned Amgen before. Remember, Amgen is one of the most recent additions to the Dow here in the last few years, as just one example. But even Caterpillar and JP Morgan and Goldman Sachs and United Healthcare and Chevron, I mean, those companies are all up there. McDonald's, up there close to all-time highs, and some of them are at all-time highs right now. And so we're not just talking about an area that is doing a little bit better. We're talking about an area that is doing considerably better for whatever reason. And you might not agree with how the Dow, gets constructed and calculates its performance and all that. And I get that, I understand, but it's still an influential index. Remember, the Dow has been around for a lot longer than these other indices. And so just from a historical perspective, it still carries some sway. So once again, the Dow has been the leader of this market. Not only does it have a green moving average like we saw with the S&P 500 and the Russell 2000, but it also has a dark green shading in the background, telling us that we still have a strongly bullish posture on the Dow Jones Industrial Average. The other thing that stands out to my eye is notice where we closed today on the Dow Jones Industrial Average. I'm not sure if we closed officially above the high of that candle, but let me just check. So the high of that candle was 33,071. Yep. Today's close was the highest point of this chart since going all the way back here to late August. We can't make that claim with these other three indices, which aren't even above last week's highs yet, let alone multi-month highs. So this is something that I'm glad we caught early. Remember, I've been telling you about this outperformance of the Dow since this candle right here, talking about how close it was to that moving average and how it would be likely the first one to break it. That was the day it put in its low at 28,660, but had that monstrous reversal. And ever since then, it has been all systems go for the Dow. So once again, it is the Dow leading. That's not the most exciting area of the market. It is not the one that we would desire if we want a robustly bullish stock market. But beggars can't be choosers, right? It wasn't so long ago it seemed like nothing would go up in price. At least now, even if it's not ideal, we do have the big blue chips kind of carrying the torch for this market at the moment. And who knows where that takes us. The other indices, as I mentioned before, are in that bearish posture territory right now. But is it possible that the Dow could just drag the rest of the market up with it? It's possible. I don't think it's going to be all that likely personally, but I will at least be open-minded enough to say that yes, it is possible. And if you are somebody that thinks the market is destined to go higher from this point on, then there's going to be some very interesting looking charts there in the Dow that you can kind of sort through. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these videos. Remember, these videos take at least 3 hours for David and I to do. I know that probably sounds like a lot, but we have to do all the research, we have to do the prep, we have to look for our trade application examples, we have to send out the notifications, we have to write the paragraphs, we actually have to record the videos, we have to edit them, we have to upload them, we have to send out those notifications, set up the emails, right? David and I do all of that on our own. We don't have a staff or anything like that. So just trying to impress upon you that if you appreciate the effort that goes into these free videos that get hand delivered to you, and you like having access to David and I, that we ask one simple request out of you. click like for us on Twitter. It only takes 5 seconds out of your time, and for a lot of you, I think you would agree that your 5 seconds is worth our 3 hours, and if you do agree with that, please continue that. As I always say, as long as we're up and over 100 likes, I'm happy to do a full-length video, and wouldn't you know, we got exactly to 100 likes this time around. So whoever the last person was to like it, I didn't see, but whoever you were out there, you are the reason I am still talking right now. Otherwise, this video would have been done about 5 minutes ago at this point. So, you can't say I didn't warn you, right? If we get into a stretch where, we're doing very short videos going forward, it's not that you didn't hear it from me, right? Obviously, I've been, a broken record around that point over time. So I will do my best to let you know what I expect. And if you guys want to, participate in that, great. On the other hand, if you prefer the shorter videos of only 15 minutes without a trade application example and without all the additional technical analysis on the 12 grid charts and all that kind of stuff, that's fine as well, right? It would save me a lot of time if I didn't have to do the longer form videos. So if you actually prefer the 15-minute videos and you think that these longer ones are a little bit too long in the tooth for you, then don't click like, right? And that way I kind of let you guys decide collectively. But we got exactly to 100 likes last time around. I thank all 100 of you that took the 5 seconds out of your day to help us along with that. All right. Also, we had a great day of classes here at Market Scholars, as we always do. I taught my dividend growth investing class a little bit earlier today, where we focused on the real estate investment trust area with some very interesting choices that one of them I don't think we've ever reviewed ever before. Another one we've reviewed a few times in the past, but it's always kind of fun looking into that new sector to kind of evaluate things differently than we would with the other sectors. Remember, with REITs, you have different metrics like funds from operations per share that would be a little bit more useful than the traditional profit metrics of the other 10 sectors that are out there. So if you are a premium member, that has been posted to our calendar already. Feel free to check out the recording. And then David taught his directional option strategies class here earlier today as well. So be sure to check that out too. And then tomorrow I'll be back in action with factor-based swing trading tomorrow at 11 a.m. Eastern time, and I'll see many of you there as we'll kind of see how the market is responding to the election results, and then hopefully try to trade that accordingly based upon our class rules. All right. Also wanted to quickly mention, I brought this up just briefly here a little bit earlier in the presentation, but I did something a little bit out of character today on Twitter. I just wanted to see how this worked. Sometimes you experiment with different things. And I did what's known as a tweet thread today. Now, as the name insists, that means that you have threaded together several posts. And as you can see here, in this particular case, there were 17 posts about my experience of Archer Daniels Midland ownership over the past decade, and some of the things I learned along the way and things that I find useful for other long-term investors. And so if you do appreciate that, that actually took me quite a long time today, I'm ashamed to admit, but I'm a little bit of a nut for details there. So it's not something I just slapped together in a few minutes. So I have to go back and, check a lot of data and numbers and, post charts and talk about different percentages and lots of different things like that. So if you're interested in my experience over the past decade with that company and you want to encourage me to do more of these tweet threads, then the same thing with the market outlook videos. We just simply ask you to do something that is so simple, you shouldn't even have to think twice about it. And that is to click like when you actually like something on Twitter and you want to encourage the content creator to do more of that in the future. If there's very few people clicking like, then it gives us, the content creators, the impression that we should do less of that into the future. So anyway, feel free to check that out on your own time there by going to my timeline on Twitter. And then also I wanted to bring up here real quick that today was an interesting day in the market outside of the stock market. Even though the S&P 500 was only up 0.5%, there were some major movements in the cryptocurrency markets. Now, truth be told, I had never even heard of this cryptocurrency before today. But after doing a little bit of digging on Twitter and other areas, I did learn that it is reasonably important because it kind of represents, a flaw in the system, so to speak. And this is FTX token. Sometimes people refer to it as FTT ST as that ticker symbol right there. But again, it's not a stock, so you're not going to pull it up on a stock market quotation system. But it is a cryptocurrency. And as you can see, it has been absolutely blasted today. It was down 74% in a single day. And you can see that 24 hours ago, this was a $22 cryptocurrency that at this exact moment in time is worth $5. And so that is an incredible meltdown for a reasonably important cryptocurrency because it kind of represents one of the bigger players in that space, which is FTX. Some of you might recognize those commercials here in the United States. If I'm not mistaken, I think that's the one that Tom Brady was hawking. As a Rams fan, I have some choice words for Tom Brady and the Buccaneers over the weekend, but that's another story entirely. In this case, it looks like Tom better do a little bit more due diligence on which companies he's representing. Now, my understanding of what I heard on CNBC is that this kind of represents the international version where there's a Singapore company, that's trying to buy out Sam Bankman-Fried or whatever his name is, his portion of the international FTX, but that the U.S. version of FTX is a different entity. Again, I'm the wrong guy to ask about all those details because it's just not my interest or my line of work. But I did want to point that out because that was a major, major situation in the market that reminds us there's still a lot of risk out there. And that did kind of go down throughout the cryptocurrency chain as well. Let me see if I can pull up like what Bitcoin was doing today on this website here. Hang on, I'm not quite familiar with it, but I imagine we can find Bitcoin. Yeah, there's Bitcoin. And you can see that Bitcoin got smoked today off of that as well. Here's kind of your 7-day chart over on the right-hand side here. And Bitcoin was above 20,000 here pretty recently. And then here is today's nosedive, basically a straight down move right there. And you can see that Bitcoin doesn't have anything to do with FTX, but just because it's in sympathy, all the cryptocurrencies, pretty much all of them, were heading lower here today. And Bitcoin was down about 10% just in the last 24 hours. And that extended to Ethereum as well, or Ether, right? That's the second largest cryptocurrency out there. It was down 15% in the last 24 hours. So again, we don't really talk about cryptos all that much in these market outlook videos. Our preference is to talk about the stock market, the bond market, etc. But this was an important enough event today where it did impact a lot of traders out there. And so I wanted to at least bring it to light and help you know that is taking place there. And that could very well become a future problem for the market. Because remember, Bitcoin trading effectively talks to us about the appetite for risk. And if appetite for risk is high, Bitcoin is usually doing pretty well. And that oftentimes extends to tech stocks on the NASDAQ. But if Bitcoin rolls over and you can see that the temperature for taking risk on by market participants is just non-existent, then that can also extend over to the NASDAQ, where most people are not going to touch those innovative and disruptive tech companies that make up that important index. So anyway, just be aware that that was a rare conversation there about cryptocurrencies in this presentation. And it does have the ability to impact the markets. As I mentioned before, the NASDAQ has been the one that's been struggling. So it's our problem child, right? It's the one that is still in that red territory there. And this is, of these four indices, this is the one that's most closely aligned with the risk-taking of cryptocurrencies. And so, yet another problem is one way you can kind of think about that. Let's also quickly talk about our sector selector here. Remember, this gets updated on Friday evenings, so it is a couple of days old at this point, but still can, send us the message of any rotation that might be taking place out there. And you will notice here that energy stayed up at the top for the 6th straight week now. Quite a long stretch of time that oil and gas has ruled the roost. And right now, I don't really see any reason to think that that will change anytime soon. In fact, some of you might have seen my tweet over the weekend. Let me see if I can find it here real quick. Should have had this pulled up ahead of time, but a lot of times I don't know what I'm going to talk about until I'm actually talking about it. Here we go. So on November 5th, I said, one of these is not like the other. And this is basically tracking the ranking system that we use, known as the WAR score ranking system. WAR is an acronym that stands for Weighted Aggregate Returns. It's proprietary to us here at Market Scholars, but effectively what it's trying to do is it's trying to take the return performance of multiple time periods and then aggregate those together, but then weight the more recent time periods more heavily than the farther out time periods to try to find rotations in various subsets of stocks, or in this case, sectors. And as you can see, we've got one line all the way up here at the top, and in this case, this is the RYE, the equal weighted version of the energy stocks. And it is, head and shoulders above all the rest of these way down below. All the rest of them are fighting for their various rankings, really close to one another. But energy is like it got a head start in a marathon type of a thing, right? And it is out there, and it's going to be a while before they give up the ghost, unless there's some sort of a major geopolitical event that affects the price of oil or something like that. So at this point, I would assume that the oil and gas sector will continue to be up at the top of the sector selector for the foreseeable future. In second place is the industrials. We've really seen some really impressive industrials charts here recently. We've talked about the defense contractors ad nauseum in this presentation and in my classes for obvious reasons, with Russia-Ukraine still going on. But it extends beyond the defense contractors. We're seeing stocks like Caterpillar, like Deere, even Boeing is starting to shape up. And we've talked about some of the smaller industrials companies. We looked at a company called Wilscott Mobile Mini in my top-down trend trading class on Monday, which has a really nice chart that's breaking out. So it's not just the defense contractors anymore. You have a more well-rounded experience with a lot of industrials companies in the market right now if you're looking for relative strength. On the flip side, unfortunately, we do see the consumer staples working their way back into the number 3 position. I say unfortunately because usually you don't like to see that. And again, remember, I personally own more consumer staples like in Archer Daniels Midland than any other sector because I'm a dividend growth investor, and that particular sector matches up very well with dividend growth investing. So I say this not because I don't like to see consumer staples up there. I personally do, but I also will say that that's our sacrificial lamb, where I'm willing to underperform in the hopes that the rest of the market can kind of take it up another gear. Because what you like to see when you have a really strong bullish market is for consumer staples and other defensive sectors at the bottom. What you want to see is communications, technology, and discretionary up at the top, and you can see that those are the ones that are at the bottom right now. So, we got a different type of a mix here this week from top to bottom, but in general, I think it does still skew towards that idea of cautiousness towards the market, where some of the defensive areas are still holding up reasonably well, and some of the compounding growth areas are still struggling to kind of gather themselves and start trying to make a little bit of a recovery. So I'll keep you posted if that changes, but right now it's kind of the same old themes that we've been looking at for much of 2022. All right, let's get back on track here with our charts and get into some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And a reminder that the green backgrounds mean that those charts have bullish postures according to the market forecast intermediate line, and then the pink charts are the ones with the bearish postures. So, as has been the case all year long, my eyes automatically drip to the lower 2 corners. And the reason for that is that has been the cause of the market's indigestion this year. The U.S. dollar strength and the ever-rising treasury yields out there. And one of those two has now broken down yet again. And this is kind of interesting because remember, this is the second time in just the last couple of weeks where I've been having this conversation with you. So it's becoming maybe a little bit more real as a result. The first time I was a little bit skeptical about it. I was like, yeah, we've seen it before where the dollar breaks down and then we recover. Remember, I was showing you if you go further back. So let me do it again for those of you that might not have watched that presentation here a week or two ago when I was talking about it. But this is a 3-month chart that we're looking at for UUP, which tracks the US dollar versus a basket of other securities. And if I were to extend this back to a 1-year time period instead of 3 months, you can see that there's been a couple of times along the way where you decidedly cracked through the moving average right there, and then also right there. And of course, you had it back here as well. It's just that it wasn't really in an uptrend at that point, so it wasn't really all that relevant back then. But this one and this one was certainly relevant to what we saw here just a couple of weeks ago. And because those two recovered rather quickly, we wanted to give this one the benefit of the doubt and say, yeah, that one can probably recover too. And for a while, it did. In fact, that was a pretty brilliant candle there that got us up to those kind of prior resistance areas. But that was a pretty epic failure. We have had a really tough 3-day stretch there with the US dollar. And you can see that we have gone all the way back to where we were trading right there on October 26th. And we actually breached the low on an intraday basis. However, we didn't on a closing basis. So that will be the next step. If we are to actually see this uptrend turned into a downtrend, we need to see it starting to close below the low of that candle on the 26th, which could come as soon as tomorrow under the right conditions, right? We're not that far away from it. The other thing that it has in its favor in terms of if you want the dollar to roll over is that we now have a red moving average. That's a little bit more serious. Remember, we haven't seen a red moving average on the dollar since going all the way back here to February 16th. That is a long time ago. It feels like an eternity ago, right? That was right when we first started hearing a whiff about Russia-Ukraine. So it has been a really long 8-month period since then. And this is the first time we have a red moving average telling us that price is now below a falling moving average. So that's another key insight there that suggests that this time might be for real. This actually might be a legitimate breakdown here. And if it is, that would go into the bullish camp for the general stock market. So if you want to see the stock market rising, you're kind of cheering on this breakdown of the US dollar. We can't share that same enthusiasm right now with the 10-year Treasury yield. And by the way, the US dollar was down 0.44% today. The Treasury yield was also down today. We talked about that a bit in my dividend growth investing class, and it closed at approximately 4.12%. So even it is starting to feel a little bit heavy up here. In fact, some of you might have seen me on Twitter or in my class today talk about that I actually participated in a 3-month Treasury bill auction here over the past week, because these levels above 4% on 3-month bills is ridiculously enticing if you have extra money sitting around. Obviously, that's not a recommendation or anything like that, but it is quite appealing here all of a sudden. It beats a lot of high-yield savings accounts. It beats your CD down at the bank. Yeah, your money's tied up for a bit, but if you know in advance that your money is already intended to be tied up for the next 3 months or 6 months or a year or whatever maturity you select, then you might as well be making some money off of that. And 4% is reasonable. Remember, it wasn't very long ago when you couldn't even get a half of 1% if you were lucky on a 3-month Treasury bill. And today you can get over 4%. And so that's a really interesting situation. And it does compete for investor assets, right? Money is always trying to find out where it is going to be used most efficiently. And if you think that we're going to have a lot of chop and slop in front of us in the stock market here in coming months, you might decide that you're better off in Treasury bills, at least earning a consistent 4% plus of interest, and then also, of course, receiving all of your money back when your bond matures. And so, it's going to be interesting to see how that plays out. But I think we're already at a reasonably high yield. We could always go higher. So, and I have some extra money sitting around, and it's entirely possible I'll continue to push into that market if interest rates do go higher. But I do think we're up there towards the top end of yields, even if inflation is going to kind of gradually work its way higher. I don't think we're going to see a massive spike higher in yields again. Again, I could be wrong about that. I'm certainly no expert in that particular area, but just gut feel tells me that we've reached some interesting plateauing levels for yields up here above 4% on the ultra short-term maturities, and therefore perhaps there will be some stabilization in bond prices as a result of that as well. But unlike the US dollar, where we actually have legitimate signs of a breakdown on the chart, right now it would just be a guess to say that on the 10-year Treasury yield. Yes, it was down today, but as you can see, we remain above a rising 30-day moving average, and we still have a strongly bullish intermediate posture according to the market forecast technical indicator. So we've got a ways to go there, but I would say that since the dollar and treasury yields have largely traveled together this year, that it is helpful for the cause. If you think treasury yields could roll over in the future, it's helpful to that cause that the US dollar is already attempting to do that. So it's possible that the US treasury yield will kind of follow suit and take its cues from what's happening with the dollar. So we'll see how it plays out. It's going to be really interesting because of the importance of those two charts to the rest of the market here in calendar year 2022. One interesting development of the last, let's call it 3 or 4 days, has been what's going on with gold. All of a sudden, gold is coming alive. And remember, gold had just gone through something like a 7-month drawdown that hadn't happened since the 1800s. That is extremely rare, right? I was talking about it in the presentation, and I can't remember if it was here or a different class that we were bringing up the charts and looking at those monthly candles in red for, I think it was 7 months in a row, which is just unbelievable for a very liquid asset class like gold prices. So my oh my, they must have stretched that rubber band a little bit too far, and now you're getting that snapback. Take a look at that move in gold over just the last 4 days. You were talking about multi-year lows on gold here just 4 trading sessions ago to be going straight up to now being up here basically at this high from where we were the first week of October. And if we clear that, we'll be at multi-month highs. So we went from multi-year lows to potentially multi-month highs within the course of a week if this stays strong tomorrow. So keep your eyes on gold. And I think part of the story there as well is what's going on with cryptocurrency. As I mentioned, here's that Bitcoin chart, and look at the chaos in cryptocurrencies right now. And remember, a lot of the cryptocurrency supporters called Bitcoin digital gold. They wanted it to basically replace gold. But now that we are seeing a lot of cryptocurrencies just going up in smoke and not always representing something of tangible value, money is probably rotating out of what that perceived safety was into actual safety of hard assets like gold itself. And so that's been really interesting. We also saw a buyout announcement amongst some of the gold mining community there. I think it was Yamana. And so, some of those values are dirt cheap because gold price has been so far out of favor for so long that a lot of the gold mining stocks could be very cheap right now to their competitors. So you never know when M&A activity will start heating things up there a bit as well. But notice that gold, if I were to, again, go back over here to the US dollar, change that back to a 3-month chart, notice that inverse correlation between the dollar and gold. The dollar has broken down for the last 4 days. Gold has gone straight up for the last 4 days. The dollar has just received its first red moving average for the last, let's call it 8 months or whatever. And gold at the exact same time now has a green moving average, telling us that price is above a rising moving average right there. So this will be quite interesting to see if this has the potential to actually be trend changing. It's possible because this is such a violent move to the upside, right? If it was just a whimper of a move, then you start, second guessing whether it's going to have the stability where it needs to in order to continue going up. But this is a powerful move up and off the bottom, and it would not surprise me if it had the ability to keep on going there. Oil did have kind of the opposite effect here today. Oil was down 2.7%. It was their second day in a row to the downside, but because they've been doing so well for so long, you can have these pullback days and still retain your strongly bullish posture. Of course, oil still has that upward trending 30-day moving average with price above it as well. So yeah, it was a poor day for oil, but you can afford to give them a few poor days here and there because you've had so many good days along the way. So I'm not ready to kind of throw oil away all of a sudden because of one bad day, but it is something we want to keep our eye on moving forward. Up at the top, you'll see that foreign stocks did pretty well here today. Remember, that is traditionally the case when the dollar weakens. So notice what's going on here with foreign securities. Look at this move on EFA in the last 4 days, from right here to way up here. Look at this move on EEM over the last 4 days, from right here all the way to up here. Now compare that to the United States in the last 4 days. From right here to right here. We did not clear that prior high on the United States. We've easily cleared those highs on the foreign indices. And so that goes hat in hand with what we've been teaching you for years in this presentation, which is when the US dollar gets weak, all else being equal, foreign securities can strengthen on a relative basis versus US assets. And right now, a lot of those foreign stock markets look quite cheap compared to US assets that have held up reasonably well over the last 15 years. So you just never know when that type of a theme could take hold as well. So it's been a really nice run here in the last few weeks for foreign stocks, both in the developed category and in the emerging category. Developed stocks were up 1.13% today, and the emerging category was up 0.72% today. Both outperformed the US's 0.54% move today. All right, let's take a peek here now at our sectors on chart 5C. And here you can see that it's a little bit of a mixed bag. You have a few examples of pink charts, and you have mostly green for the rest. And I think this is a really good educational view that we're looking at right now for what we've worked with you on in the past, which is the S&P 500 is market cap weighted. What are the three most important sectors for all intents and purposes due to that market cap evaluation? And that is communications, technology, and discretionary. Because communications is where you're going to find Alphabet and Meta and also Disney, as we're going to find out here tomorrow morning. And then technology includes Apple and Microsoft, and discretionary includes Tesla and Amazon. And with those companies being some of the biggest market cap companies in the United States, they are effectively the most influential on the S&P 500. So here is a fairly rare example, but a good educational one, where the S&P 500 has a weekly bearish posture, even though you've got 1, 2, 3, 4, 5, 6, 7, 8 out of 11 sectors with strongly bullish postures. Think about that for a second. 8 out of the 11 sectors have strongly bullish postures. Yet the S&P 500 has a weekly bearish posture because of the influence of those outliers right there that I had mentioned before. And no surprise, at least to me, after looking at the heat map here earlier in the presentation, today's worst performer was discretionary. Remember, Tesla and Amazon were both down on a day when most stocks were up. So the discretionary sector was down 0.25% today. They were actually the only sector that closed in the red. In terms of which ones were the best, it looks like it may have been materials there. Yeah, it was. Materials was up 1.72% here today. So a nice healthy day there for the materials. Some of you saw me tweeting about Albemarle, the lithium mining company that goes hand in hand with all the electric vehicles these days. It was a celebratory day for many of us at Market Scholars because not only did we buy Albemarle at $67 per share for the dividend growth investing class less than 3 years ago, and it hit an all-time high today above 310, but we also bought it for my top 10 trend trading class when it started to click into a trend within that time period as well. So we have two different cost bases on that particular company of Albemarle, ticker symbol ALB, yet both of them, whether you bought it when it was low or whether it was somewhat higher after the trend started, you've got a smile on your face today with Albemarle. There's the ticker symbol way up in just the last 4 days or so since they reported their earnings. If you were to kind of get the full level of my enthusiasm, you might not receive it by just looking at a 3-month chart here. But let's pull up a 3-year chart, which is when we bought Albemarle in both of those classes that I had mentioned. And this has just been absolutely spectacular. This stock is up 362% without even including the dividends in just 3 years worth of time. It has been an absolute home run. With dividends reinvested, that's more than a quadruplet. In fact, it's almost a quintuple in less than 3 years for us. So that one has been a massive, massive winner for many of our market scholars out there, whether they're part of my trend trading class or my dividend growth investing class. And with Albemarle being a lithium mining company, it was one of the more influential members within the materials sector today to help cause the materials to lead the market here today. All right, let's now get into the trade application example. Now, a reminder that we do these trade application examples while the stock market is open, and then we send out all the details of those trades with the screenshots and the fill prices and strike prices and all that kind of good stuff to our premium members while the stock market is still open. So that way they can consider it for themselves if they so desire as well. Whereas everybody else who's not a premium member would just learn about it in the free video later that night. So that's yet another big perk for being a premium member of Market Scholars. And I hope you become one here in a few weeks when we do our Black Friday sale. So this trade is already done, as they always are, but let's talk it through, and I'll show you what I was kind of thinking with it. So let me come on over here to chart 3A, and let me pull up ticker symbol MAR. Now this is one that most of you will be familiar with. This is Marriott International, and obviously one of the biggest hotel chains, not only here in the United States, but globally as well. And Marriott's been acting reasonably well, but then again, the whole market's been doing okay here in the last 3 days, but this one's no exception. You can see that after selling off with its earnings announcement, and that also included that time period with the Federal Reserve announcement, it has now been stabilizing right here at this upward trending 30-day moving average. You can see that the background color of this chart 3A went to blue from pink, telling us that this blue line, which we use for swing trading purposes, is now considered bullish once again, now that it's popped out of that lower reversal zone right there. You'll notice that Marriott is also outperforming the S&P 500 itself with this gold dotted line here representing the pathway of the S&P 500, but it's not dramatically so, right? It's not one of those epic outperformers like a lot of the oil companies. This one's just a small minor outperformer versus the market at large. And as I mentioned to you guys earlier, I am still somewhat more hesitant towards what the future of this general stock market holds for participants. I'm a little bit more cautionary because I've always been told don't fight the Fed and don't fight the trend. And the trend of the market, at least for the NASDAQ, is still down. And the trend of the Fed is still certainly hawkish. We learned that last week. So my mindset is one where I think we should be probably struggling in the stock market. But my eyes are somewhat telling me a slightly different story. So you can see where I have that internal conflict. My eyes are telling me that, some of the charts are stabilizing pretty nicely. And this is actually a good example of that, right? I mentioned before how the Russell 2000 had that concept of breakout retest. This chart has that as well, right? You had this resistance area over here in the first week of October. You broke through that. Then you had that 3-day sell-off. And where did it stabilize? Lo and behold, exactly across the tops of those candles over there. And we've now been rolling back higher after testing that zone once again. So, that's constructive activity, and I want to acknowledge that. So when I have a conflict like that where, I recognize that the chart looks okay, and I think that the general stock market probably should be a little bit more bearish, then I think that's a good iron condor opportunity. And with this particular stock trading basically in the middle of its 3-month range, that's what I opted to do. And in this case, we've already gone through an earnings announcement, right? A few weeks back, we didn't have that luxury because so many stocks were reporting their earnings. Now, hundreds of companies have already reported their earnings, and therefore, between now and the December monthly contracts that I chose for the trade, it'll just be trading off of its own kind of organic technical analysis there. And you can see my blue lines on top and on the bottom will represent my break evens for this trade. So I did the 170, 175 call spread at the top to sell. And then on the bottom side, I did the 130 to 135, I think. I'd have to double check to see if I've got those levels drawn. But the point is, I selected those areas specifically because I wanted to make sure that my break evens were above the high and the low of this trading over the past 3 months. Now, that's not a guarantee. Obviously, you can break out of your channel in one direction or another. But if you're ever going to put on an iron condor, you'd probably like to see that its past history has had a tough time gathering itself and fueling momentum to the upside or the downside, and you're expecting it to just kind of stay within that range between now and that expiration, which again was the December contracts there. And again, you guys that are premium members, you can look at our Telegram for my actual screenshots of the trades and all that kind of stuff if you want to find more details. But that was the general idea there of a stock that is stabilizing nicely around its moving average after a sharp sell-off and now is trading in the middle of its range, where if you expect this stock to go sideways or the market in general to go sideways in the coming month and a half or so, then this one could be a trade that could be effective for you. It was a 30% return on risk, which is what we typically shoot for these types of trades. Okay, so that's what I had for you here tonight. I hope you got value out of this conversation, this presentation. If you did, as I mentioned before, I have one simple request from you. Click like on Twitter. It only takes you 5 seconds and it doesn't cost you a penny. And remember, there's 4 different ways to find the tweet in question. You can either go to my Twitter timeline where it will be pinned to the top of my timeline. You can just click like on the little Twitter widget underneath the video if you're watching it directly on the Market Scholars website. You can find the link to the tweet in question in the description area of the YouTube video for those of you that watch it at youtube.com. And then last but not least, you'll also find a link to the tweet in question in the Twitter icon at the bottom of the emails we send you guys that are on our distribution list. So however you choose of those 4 different options, they all kind of get collected in the same place. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Thursday, I'll be happy to give you another full-length video, including a trade application example like this. If you'd prefer a shorter video, then don't click like. And if we're under 100 likes, then I'll just do a 15-minute video with no trade applications. We'll let you guys decide collectively on that. But whatever you decide on that, I appreciate you stopping by and listening here tonight. Good luck with those of you that have still yet to go out and cast your votes, and best of success with your trades and your investments. Goodbye for now.